Right now, the US tax law gives homeowners a pretty valuable exclusion when you sell your primary residence. And that is $250,000 can be excluded from capital gain if you're an individual tax filer or married filing separately, or $500,000 if you're married filing jointly. And what that means is that you can lop off that $250,000 or $500,000 from your sale, which would then decrease your capital gain on the sale. That can be a tremendous value for those of you who have experienced increases in value in your primary residence, especially since this law was enacted, which by the way was 1997. So remember when $500,000 actually meant something? Okay, that's a little tongue-in-cheek, but it's true when it comes to gains in real estate over the last 27 years. So let's rewind to 1997. Bill Clinton was the president, Titanic was #1 in the box office, and AOL was how we logged on to get online. That's how long ago it was. This law was enacted in order to replace what was known as the basis rollover rule, where you could just keep rolling your gain over if you bought another primary residence, and your gain and the tax would never be triggered until you ultimately sold and didn't roll it into a new primary residence. This law was enacted, one of the main reasons is to benefit homeowners, to give them value in their primary investment, their primary residence, but also because the record keeping for people that stayed in their homes much longer was becoming very cumbersome and onerous. In order to keep all the records necessary to track your basis, any improvements you made to your house, anything from renovations to landscaping to replacing mechanics or fixtures, all of that stuff increased your basis, and it became very cumbersome and onerous for taxpayers to hold on to that for, say, 27 years. But here's the problem. The law has not changed, and the number has not been indexed for inflation like most tax laws. So the median sale price of a house back when this law was enacted in 1997 was $115,000. Today it's like $415,000. That's a 250% increase. So while the exclusion might have seemed generous at the time, because of inflation, time value of money, major increases in residential real estate, it's not so generous anymore. So what the huge capital gains tax bill is doing is keeping people in their houses longer. So for instance, lots of seniors have most of their net worth tied up into their primary residence, but it doesn't make economic sense to sell because they're going to take a huge haircut with the capital gain. So that's also contributing to the shortage of housing for the next generations to come in and buy these properties. So something has to be done to sort of like create some movement with some of these people that are house rich but cash poor and can't even tap into their equity because they're no longer working in order to live a comfortable retirement. So there is talk in Washington to resolve this, and that is a bill that's on the table that would double the exclusion amount to $1 million and also index it for inflation. This would be a great help for those seniors that are stuck in their homes because of the capital gains tax that they'd have to pay. So right now, the best move is to know your numbers. The right timing, planning, and strategy can make a huge difference on what you ultimately retain after the sale of your primary residence. So if you're thinking about selling, let's sit down and talk through your options together so that you make the right strategic move at the right time.